How's it going, guys? We're in the middle of December 2022. It's hard to believe that we're almost inching into 2023. And wow, it's been a crazy week in the mortgage and real estate market. Nick, tell us about it.
Yeah, Tuesday, really big report came out, which was CPI, Consumer Price Index. The main thing that we were looking for there is core inflation. So core inflation is critical. That subtracts out or that takes out things that are a little bit more volatile, like your food and energy costs. And we actually saw a 0.3 reduction. So this means that our year over year core inflation, which analyzes November 2021 and replaces that with November 2022, is down 0.3%. Huge positive. And we actually saw interest rates improve based upon this news. Now, we've discussed this and really predicted it, right, in some of the previous CPI reports. And if you look at and forecast out again the upcoming months, we think that this trend will be consistent upcoming. So a lot to be really optimistic with in terms of inflation and how interest rates are going to react to inflation going forward. But that was only Tuesday. Then we got to Wednesday. What happened Wednesday?
On Wednesday, it's what they call Fed Day, and that's where the Federal Reserve meets at their monthly meeting, and they decided to increase the federal funds rate by 50 basis points. And I want to take a second to explain what that actually is.
Because interest rates didn't go up
Yes.
0.5%, did they?
No, they did not. So what the federal funds rate is directly correlated to is short-term interest. Though that would be things such as credit cards, home equity lines of credit, or auto loans, while mortgage rates are actually long-term interest. So typically, whenever the Federal Reserve increases the federal funds rate, it has a positive effect on mortgage rates because it shows bond investors that the Federal Reserve is taking action on fighting the issues of inflation.
And wasn't 50 basis points pretty much expected?
Yes, it was very expected.
And so we're coming off of 4 previous meetings where consecutively we had a 75 basis point increase. And I think if we take a step back and look at the bigger picture, now the one good news of that Fed meeting was probably that it's the last Fed meeting of the year, right? If we look at where the Fed funds rate is today, which is between 4.25% and 4.5%, and where it started. So the beginning of the year, Fed funds rate was 0 to 0.25%. So just in the last 9 months, we've gone again from 0 to 0.25 to 4.25 to 4.5. So we've literally got up over 4% in 9 months.
Yes.
Right? So this was the Fed's, basically aggressive push that they wanted to use to fight inflation. Now, some of the commentary after the meeting was that we project in the first meeting of 2023, we're going to have a 25 basis point increase. And after that, there's actually some belief that we may have a slower increase or maybe even a pause on what the Fed's going to do with interest rates going forward. What does that typically tell you?
That typically tells me that, well, at least I'm always looking in the eyes of investors. So investors should have a little bit more confidence that the Federal Reserve is first and foremost recognizing that inflation is a problem, but they're also taking action on trying to combat it. So that should have a positive reaction on the bond market, and rates should continue to improve.
I agree. Yeah, I think there's just a lot to be optimistic on as we trend down in inflation. As long as that Fed funds rate holds, potentially even maybe by the end of the year, we start to see some decline, depending on what happens with jobs. Then I think, again, all of this leads us to next year sometime having a much higher increase in the affordability of housing, which should make all home buyers a lot more confident to get in the game and buy homes.